FTX collapse explained to a 5-year-old. There once was a silly, curly-haired man who sold lots of people in the village magic beans. The villagers were happy because they thought the beans were magic. Once the villagers realized the beans weren't magic, they stopped believing in the beans and asked for their money back. But the silly, curly-haired man had already spent all their money. FTX collapse explained to a 10-year-old. Someone we all thought was smart used to own a bank on the internet. He was also someone that thought he was good at gambling. He used his bank to create fake money so that he can continue doing what he loves, gambling. He then played a big game which he lost, and he had to pay the price of losing all the money he gambled by stealing money from his own bank. This money from his bank didn't belong to him. It belonged to people who trusted his bank and put their money into it. Once word got out about his gambling losses, the people rushed to the bank to take out all their money. But it was too late. There was no more money in the bank to pay them all back. FTX collapse explained to a crypto newbie. Sam Bankman Fried, also known as SBF, founded 2 companies which he claimed were separate from each other. One company was a cryptocurrency exchange called FTX. This is the website where people can buy and sell cryptocurrencies. The other company was a hedge fund called Alameda Research. This was an investment firm full of traders looking for arbitrage opportunities to make money. SBF used his FTX exchange to create their own cryptocurrency. They called it FTT and created so much of it, they sent it to Alameda Research. Turns out, those 2 companies were not separate at all. All the FTT token on the balance sheets of FTX and Alameda Research gave the impression that both companies were healthy. When customers found out that most of the balance sheets were a cryptocurrency Sam Bankman Fried had made up out of thin air and assigned a value to, those customers panicked, rushed to sell the FTT they had, and withdraw all the money from the FTX exchange. But it was too late, because Sam Bankman Fried had already secretly taken all their money, around $10 billion to be precise, given it to Alameda Research and their CEO, Ellison, who then traded and lost all that money. FTX collapse explained to a crypto pro. Sam Bankman Fried was the founder of FTX, the cryptocurrency exchange, and Alameda Research, the hedge fund. Alameda Research specialized in making big trading bets and investments in crypto companies. To finance these bets, Sam Bankman Fried raised money from investors like Sequoia, SoftBank, and Temasek, offering them high returns at low risk. Many sophisticated institutional investors believed him and gave him hundreds of millions of dollars. Until recently, FTX was the 5th largest cryptocurrency exchange. They also had their own token called FTT, which gave users on their platform perks like discounted trading fees. FTX minted lots of the FTT token and used it as collateral to take out loans for Alameda Research. This was a dangerous practice because if the price of FTT fell below a certain level, it would mean Alameda Research would be able to pay back its lenders. Unusually, in 2022, Sam Bankman Fried was trying to bail out crypto companies due to the market falling sharply. In hindsight, Sam Bankman Fried may have been doing this to prevent these companies from selling their FTT tokens at a discount so he could keep his secret charade going. In early November 2022, CoinDesk reported that 2/5 of Alameda Research's $14.6 billion balance sheet was held in the token they created out of nothing, the FTT token. This sparked panic amongst FTX's customers, who realized that problems at Alameda Research would likely mean problems for FTX too, since they were closely linked. CZ, the CEO of rival cryptocurrency exchange Binance, tweeted that he's going to sell all the FTT they had, which was a lot, and this sent the FTT price into freefall. CZ then announced they were looking to buy out their rival FTX, but abandoned it once they saw how badly the finances actually were. We've come to learn that Sam Bankman Fried created a secret backdoor in FTX's bookkeeping system that allowed him to move depositors' money off the FTX cryptocurrency exchange to Alameda Research. This was done without his customers and even many of his own employees realizing. If that wasn't bad enough, Sam Bankman Fried also gave himself a $1 billion personal loan from customers' money too. Enjoy these crypto explainers? Subscribe for more.